Hey there, wealth secret seekers. We are back here with another episode. And today we're going to be riffing on an idea. And again, as per usual, there's never a right answer. But this question that I saw this question that I saw posted on social media was a great one, and I actually responded to it. I'll do my best to find it again and link it up in the show notes on this episode. But basically, it was an individual here in Canada who just finished off paying off their mortgage. And while I don't have all of the details, like I don't have all the nuances, it sounds like they were trying to aggressively pay it off. Guessing here, but I'm making some assumptions that they were making, call it doubling up payments or increasing payments in order to pay that mortgage down. And they've now lifted this huge emotional sort of stress or weight off of their shoulders. And we wanted to take this because the question was like, what do I do now? And I think it's an amazing question because there's so many things that could be done. And we need to know a lot more about this individual to know what's a good move for them. Mm-hmm. But one thing that we do know is that there's going to be some rational thoughts that we can share here that might be a good fit for that individual or maybe some of those who are listening. And here's the thing. This episode isn't going to just help people who have or are at that point where they're like just around the corner from paying off that full mortgage. It's for people to be thinking about as they plan forward. So let's say you just bought a home, your first home, or if you're halfway through paying down a mortgage, or if you're coming around that river bend to pay off the whole mortgage. We're going to be talking about some of the pros and cons to paying off a mortgage early, or simply paying down the mortgage on schedule, because I got some ideas there too that might ruffle some Dave Ramsey feathers that we're going to offer. And again, no advice here. We're not saying what is the right move for you, but these are all things, thoughts to consider as we move forward.
For sure. So, when you think about paying off your mortgage and you said the emotional, feeling of that is like for so many of us for so long, that's been our goal is like to pay the mortgage off. I remember if you went back and listened to the first few episodes of this podcast when we were called the Invested Teacher Podcast, you'll hear Kyle saying like that was his only goal. It was to aggressively pay down that mortgage. And really It was like, we're trying to create this like, hey, I can create a pocket of money. I know my thought was like, it'll be the easy street. My life will be easier because I don't have to like dedicate half my income to paying down, my paycheck to paying down this mortgage for a long time. You'll all of a sudden have this pocket of money. And, the question is like, well, now what? Like now what? Because here's the scary part, right? And this is the scary. I shared this on a previous episode too. Is my father paid off his mortgage early, so I think he paid off when he was 40 years old. I think that's the number. But it was like
this is a great story, by the way. You didn't say you were going to bring it up. I love it.
I didn't, but I know that it was like I asked him specifically recent, like I think it was a year ago. I asked him because my brother, he was also getting close to paying off his mortgage, and he's 40, and he was saying, well, what should I? He was asking that question. Well, what should I do now? And I remember going back to my father and saying, like, well, what did you do? Like you paid off your mortgage, then like tell us what you did with that chunk of money, because all of a sudden you've got this pot that all of a sudden you can be redistributed or put towards investments or, put towards your financial future, to make yourself, get closer to say retiring early or having this, this financially independent area that he maybe was always working towards because he was a pensioner. And he literally said he didn't know. He didn't know where the money went because, I know something came up and all of a sudden, we had to pay this and something else came up. And I think we were getting ready for school and it was like, okay, well, we had to pay for this, maybe this books at the university. And all of a sudden it was gone. Like the lifestyle crept up for them so much that he now couldn't say where the extra monthly payment had gone. And it just kind of was absorbed into the daily budget or the monthly budget. And
Hmm.
and I remember that was the warning that I gave my brother. I was just saying, like, look, you got to make sure that, like, what are you going to do that? Because here's the downfall. It's going to get absorbed into your daily budget if you don't do anything with it. And is that what you really want? Are you looking to go and, like, go, hey, I've got this, like, I can now spend freely and I don't have to worry about what I really want to do. Or maybe there's something that I want to add to my lifestyle that I've never been able to add. Like, those are the choices you have to make. But realize, if you don't make any choices about where this extra, payment is going to go, that's what's going to happen. You will be like him, where he didn't know where it went. It's just going to be gone. And I think that's not what you're after. Like, the people who are saying, I've been aggressively paying down my mortgage to be financially free, because that's one huge item off your list to make sure that your passive income outweighs your monthly expenses. You have to figure out, what are you going to do with those dollars? Because if you're trying to grow your wealth, then put them towards something to get you there quicker, or get you there so you're stronger, or like, I don't think we're in the business of, if you're listening to this podcast, of business of just maintaining our current, wealth and going like, hey, this is exactly where I'm going to be forever. We're all looking to kind of pad and build that financial floor up every year. Mm-hmm. Can we get it stronger? And if you don't have a plan for where that dollar is going to go, it's going to be gone.
Yeah, that's a huge lesson right there. And, if we roll back and you had said, like, obviously some expenses came up, right? And your father was saying, like, maybe it was like you guys were heading off to university, maybe you were heading to here. But here's the thing. One thing I know for certain is that if, let's say, they had one more year on the mortgage. Mm-hmm. So that meant they had mortgage payments those months. They wouldn't have missed that mortgage payment, and they would have still made it through, and they would have still been here today to have this conversation. Sure. And they probably they wouldn't go like, the toughest year of our life was that year before paying off the mortgage, like, man, things really got tough. Like, there was more expenses that just showed up in that 1 year. Like, no, it was just lifestyle creep took over. So there were expenses, but here's what really happened is that there were all these other things that just squandered the money, right? Sure. Like, it's like you give yourself permission, and that actually, like, I want to give people permission, like that, if that's your plan. I like what you said. It's like, you have to just decide what it is so that at least and then that way, 20 years from now, you can say, what we did? We decided that we wanted to take that extra $1,500, $3,000 a month, whatever, to go out to dinner more often, to, golf more, to like whatever. So at least you go, I know what I did. I got something out of it. You can then assess whether it was worth it to you or not, but at least you did what you had planned to do. But if you don't, it will just kind of evaporate, and you'll just say, life was, pretty good. But I would argue if, let's say they saved that money and put it somewhere else, they would also say life was pretty good. It's probably not going to impact things in the long run, especially their memories of how things went. So that is a huge, huge piece that we have to be thinking about is your plan, if you are paying down your mortgage more aggressively, like, let's imagine you have a $2,000 mortgage, and let's say you're committed right now to paying $4,000 towards that mortgage, because that's a goal you have. I'm not going to take that away from anyone. It was a goal of mine. And then I recognized, I think I can do better than putting all that money into this home. The key is when that mortgage is gone, that is not just a $2,000 mortgage payment you're getting back. You're getting $4,000 back. So the question is how are you going to allocate those $4,000, right? You had $2,000 you had to pay. You had $2,000 that you were voluntarily paying for a long period of time. That's a large sum of money that's opening up. For some people, they might say, just by doing that and getting to that stage of life, that $4,000 back in my lifestyle can actually go towards my financial freedom number, which is all I am looking to do. And that I will be able to survive based on the other assets that I've accumulated in, whatever shape and form. Sure. But just know that home itself is not going to produce you cash flow to assist you with that financial freedom number. It will give you back your mortgage payment and the extra payments. So that is something that's really important for us to analyze here.
Sure. And I'm going to argue, like, you said something really important right there by saying, like, that home won't give you more cash flow unless you make use of the equity in your home, right? Because
Mm-hmm.
like when you said that you're going to get $4,000 back in your pocket, you technically are getting more than $4,000 back in your pocket in a way, because your home's value likely is going to go up every year, right? Like, let's say you pay off your mortgage, you're debt free, which is a lot of people's goal. And all of a sudden it's like, let's say my house was $1 million. Now I have $1 million in equity sitting there doing nothing. We call that debt equity. It's sitting there going like, maybe your financial plan says, I'm going to cash that in later. And that's going to fund the rest of my life. Like, that might be the case, but it's sitting there doing nothing. It is appreciating in value. Hopefully, in the long term, it's going to appreciate in value. So when you take that $4,000 and you put it back into your budget, really you've got that other money that's sitting over there appreciating in value, but you're not doing anything with it. Like, that didn't come along with it. Whereas like, so when we switch gears and say, if we do have access to the equity, can we make use of the equity in that home for other purposes to add to our assets, to add cash flow? So can we take this, value of this home that's now paid off, but then get it so that we can then go, hey, let's buy that, which is going to produce cash flow in my pocket. And now you've got two uses for every dollar, right? You've got that dollar that's like sitting in the value of your home appreciating, but then you borrowed it and said, I'm going to do some arbitrage on this. I'm going to take it over here and I'm going to buy this rental property with some of this equity, or I'm going to put it in the S&P 500, or I'm going to buy this asset over here. And all of a sudden now that asset's appreciating. This asset over here is appreciating. This asset also might be cash flowing. And the arbitrage over here is all of a sudden putting money in your pocket, but you did nothing with it if you don't have that plan, if your house is paid off. Now, here's the kicker, right? You could do this now without paying off your house, which a lot of you listening right now do this. Like, you're using your HELOC, your home equity line of credit, to make these choices. We're doing that. We've been talking about that a lot here on this podcast, is you're using that asset to go and make more assets and make more money and put in your cash flow. The likelihood of you doing that by listening to this show is high. So the question is like, have we maxed that out? What do we do? What do we do when we run out of HELOC? Do I want to always use my HELOC? It's like, if we're already okay with this idea of like using my HELOC to buy assets, a big wonder that I used to have for a long time is like, how do I get another HELOC? Like,
exactly.
Do I have to buy another house to get another HELOC? Yeah, my rental property, but then there's money stuck over there, and sometimes that's tougher. It's like, I want more capital. Can I get more capital? Because we know that we can make more money.
I love it. Now, here's the interesting part, is that there's no perfect way to do this, and everyone's a little bit different. And sometimes it just takes, changing your mental state, your psychological thoughts around debt. We have a debt episode that we released a few weeks ago. We'll put it in the show notes. So if you haven't listened to that yet, you really should. But like, think about this. There's two things that popped into my mind as you were sharing that, John. So what I was thinking is, okay, when you have this mortgage, you might be contributing more than you need to, rather than kind of going the whole other way and like, being like, I'm going to pull everything out today. One small shift you can make is just make the regular payments and take the extra payments and start putting that into investments. Like, that's a really easy way to slowly slide into this thing. Because here's the interesting part, is that you talked about the homes appreciating, and we look at it and we say, yes, they go up in value over time. That's a thing we know. But the reality is the majority of the appreciation of typical homes and real estate and property in general is actually the dollar losing its value, right? Like, we're actually like able to buy less with the same money. And that part is happening naturally when we have a mortgage. So when you have a mortgage on your primary residence here in Canada, we can't speak to everywhere in the world, but here in Canada, you are likely getting some of the best borrowing rates possible. When you try to take out a mortgage on a rental property, you get less favorable rates, right? The risk is higher on the lender. So the thought is, like, if you can borrow money, some of the cheapest dollars in your pocket, and remember, when you are borrowing money, the interest rate is set based on essentially inflation numbers, right? Like the higher inflation is, the higher interest rate goes for borrowing money. So the reality is, if we can stretch that out longer, you are going to be net ahead, specifically if you take the extra money that you are not putting into brick and mortar or your home and you put it into other assets of your choice. It's totally up to you. We're not going to tell you what that should be for you. But that is a fact, and it's really important. But here's the other part that I think is really critical. You talked about the idea of people potentially selling their home later to help them for cash flow, right? Like if that's your ultimate move, your ultimate goal, imagine like selling your home means you've now lost the asset. Like you don't have that home anymore. It's not growing. So if it's $1 million home, people always say, I'm going to downsize. You've taken $1 million, which is capital gains tax free. You have a capital gains exemption on your primary home. It should actually be the last thing that you sell to downsize because you are getting a capital gain on $1 million. Whereas if you go from $1 million and you downsize to 500,000, first of all, you lost a lot in expenses and all those things. But now you have a half the value is appreciating, which means you're getting half the capital gain, which means you are gifting back to the government half of the capital gains exemption that you had on that property. So in a perfect world, you'd actually be scaling up over life and you would never sell that asset because that capital gain asset is going to be a huge tax advantage. One of the greatest tax advantaged gifts that we have as Canadians. Like in the US, they don't have that same opportunity. That's why they get to expense their interest. They actually get to write off interest on their primary residence. A lot of people don't like that here, that we can't do that. But we don't actually experience a gain on our property, which is fantastic. So the thought should be, let's make sure that we don't put too much money in this property. Because remember, if I put $1 million into this property, it could be stuck there because the bank doesn't have to give you money. They don't have to lend against that property. And even though the property is worth $1 million and you only want to borrow 200,000, if they look at your income or they look at your T1 general or they look at what's going on in your life, ooh, shoot, you're behind in this or you're behind in that, you come on tough times. Now I want to go back and get my money. Guess what? The bank's going to say, no, even though you've got $1 million home right there, I don't think that you're good for it. And we don't actually want to take your home and sell your home and have to give you the difference after. They just want their interest. So these are things that we have to be really cognizant about when we're trying to think about things like debt. And we go, I want to get that debt gone because in my mind, I know that it's a lot of interest. But remember, if I'm paying a 5% mortgage, if I get the same investment at 5%, guess what? First of all, if I borrow against the home, I get a tax write-off on the 5%. But then secondly, I'm actually growing an asset at 5%. So even if they were exactly the same, it's like the money you paid in interest over here and was tax deductible, guess what? Over here, that money is growing at 5%. And now I have an asset and I can sell that asset at any time if I needed to in that tough time where I don't have to rely on a bank. So this gets very complex, I know, as we dig in here, but we really need to be thinking more deeply than let's pay off the mortgage, because if we have that as our only game plan, we're actually leaving a ton of opportunity on the table.
That's a secret sauce for me for sure, is what you just said, is that, and I think a lot of us are, if you're trying to move towards, as an entrepreneur, a business owner, and trying to kind of get to this point, and this is what scares me about, say, when you say retire and you've retired to a passive income source, is now it's tough for you to show that you have like regular income. It possibly could be, right? The bank's going to be like, let me see your T4s. Let me see like how much tax you're paying. Let me see how much income you've produced. Oh, well, you don't meet our criteria now to borrow against your own home. And now you're out of luck to buy assets from that, which sounds not awesome because you're at their mercy, whereas if you do go and say, start earlier and go say, you know what, instead of aggressively paying my mortgage off, or if I'm close to paying my mortgage off, I'm like, what am I going to do with the extra mortgage payment? I would recommend is what we've done, is let's investigate using a whole life insurance policy to be the exact same replacement as the HELOC. Because if I'm okay with investing in a HELOC or using my HELOC for investment purposes or buying assets, like describing what you just said is like, hey, I can put it over here. I can write off the interest. I'm going to make money on that asset. Like then there is no difference between using your HELOC for that and using the cash value in your home or your whole life policy, because they function the exact same way. Instead of say going out and buying another house or another asset and borrowing against that asset, the asset is you. You're going to say put a monthly payment or an annual payment towards yourself, and then that cash value is there to borrow against. And the nice part about that, and this goes against like not goes against, but contradicts or is the kind of like the kicker when you're going to the bank and saying give me, I'd like to borrow against my house, and they're like no, and they're like when you go to the insurance company and say, hey, I've got this cash value that I've accumulated year to year to year. And I would like to borrow that value to go buy this asset. They just say, where do you want me to put the money? Like there is no, and as also it's not listed as a debt. It's not on no one really knows that you've borrowed this money other than the insurance company, because you're the asset that's going to cash in. They don't care whether you have enough money because they're going to get paid back. At some point, some point you're going to kick the bucket here, and
we've dropped secret sauce to inform people in the past that, hey, guess what? You are going to die at some point, right?
Like this is why that's why they don't care about all those things. It's like you've got this asset that acts exactly like a home equity line of credit, but it's easier to get access to your money. It's just as liquid. And you don't have to ask for permission to use it or get revalued. Once you have your home equity line of credit, you don't have to ask for permission to borrow against that home equity. But if you needed to refinance it, you do. But you'll never have to do that with your whole life. This is the move that we've made. It's like, let's go get one of these to add to our capital pile, so that we can be flexible when we need to. And that is the secret sauce that allows us to add to our assets when, say, you're close to paying off your mortgage, or you don't want to touch your mortgage, or you can do both at the same time, because it's not an either or.
Right. I love it. And here's the interesting part. I just had this interesting epiphany as you were saying this. We've been doing this for years, like we've been doing this for a long time, but I've never thought of it in this exact way. And this is why I love doing these episodes, because every time we talk through, like you and I, we don't talk at this same depth on a daily basis, because we just, we kind of feel like we both know a lot of the similar things. But when we're actually putting an episode together, we start to try to articulate it for others out there. So we try to do this for the audience. We start to describe things in ways that are kind of unique to you and unique to me. And what I'm hearing you say is, like, I gave the example of, you got $2,000 mortgage payment.
Yeah.
You have this person who is putting this extra $2,000. Now, the numbers, you can change them however you want. It doesn't matter. And they don't have to be equivalent, of course. But you have to pay $2,000 because that's what the terms of the mortgage are. So you have to continue paying that. Great, go for it. But that other $2,000, what I heard you just say right now, for someone who's paying it off without a line of credit, they're putting an additional $2,000 into a home that's going to appreciate whether you do that or not. It is going to save you some interest over the long term. But remember, your current, say, 5-year term that you have with your insurance or with your bank company, it is going to save you some of that interest, but it is now stuck in there. And if you want to get it back, you now have to ask them for a home equity line of credit, or you already have a readvanceable home equity line of credit, so it's available to you. Great. What I just heard you say is, rather than do that, rather than take the extra $2,000 and put it into the mortgage to open up room, or to lock it up because you don't have a readvanceable home equity line of credit, you're saying you could take that $2,000, you put it into a permanent insurance policy, and you're going to generate cash value there, and you'll be able to leverage that, whether the insurance company likes you, likes your credit, likes your family, likes the economy, likes anything that's going on. Whether they like it or not, you have access to, and the insurance company, it's 90% of that cash value, whereas
it's not going to go down either.
Exactly. And not all of your equity can be borrowed out of a home. You can borrow up to 80% of a home on a traditional mortgage, and up to 65% on a home equity line of credit. So what you're saying is, if that's your move right now, you could immediately do this move better, even though we think you should then leverage to buy more assets. But even if you don't want to do that and you're just thinking about, nope, I just want to put more towards my quote unquote mortgage, you could be putting that same amount towards a policy and have the liquidity that you wouldn't actually have on paying additional funds into your mortgage. To me, that's a massive, massive secret sauce for, I'm sure, many of the people who are listening to this episode. And here's the last one that I want to share, and then we're going to wrap this thing. Is that every 1, 2, 3 to 5 years, typically here in Canada, you have to renew your mortgage, right? It can go longer, but very rarely do you see people going longer because you're taking a hit on the interest rate, right? There's more uncertainty for the banks. The interesting part is when you get to renewal time, you have options to ask the lender or to actually refinance. And what I mean by that is you could actually say, hey, listen, I want to keep the current balance of my mortgage. Let's say it was a 25-year amortization. You pay 5 years. You have 20 years left. You could say, you know what? Are you okay with stretching it back out to 25 years or stretching it out to 30 years? And what that does is it reduces the payment. And if you're going to do something like this, I just want you being smart with what you do with the extra funds. Those extra funds that you're saving on that payment, you could then put it into an asset directly, or you can funnel it into a policy and then leverage the policy to put into assets. But think about this from a depreciation standpoint of the dollar. If you go and you have 20 years left, you can go to that lender and typically anyone can go and now extend to 30 years amortization. That's going to reduce your payments. It will increase the interest you're going to pay over the long
Over
term.
time, sure.
But if you take those dollars and you put them to other investments, and we're talking investments that are, we'll talk index funds, real estate, like whatever you want to do, you are going to be net ahead in the long run. And here's the thing, your actual cash flow needs at minimum for this mortgage are going to continue to go down unless you refi out more equity and you stretch the amortization. But these are things that aren't advertised out there because, of course, we don't want to put people in a bad spot. But if you are diligent to be listening to this podcast, to be caring about your financial future, to want to build wealth, I'm sure that you have the dedication and the determination in order to follow through on these things. So that $2,000 you had to pay might turn into $1,750 the next time you renew if you choose to extend, and potentially it could go or stay the same by pulling equity out and putting that equity into something else. Whatever you choose, just know what that choice is and what you're giving up in order to sort of scratch that emotional itch, right? To get to zero debt is a great goal, but it's a very emotionally charged goal, right? So just make sure that on the rational side, you know what you're leaving on the table, because for many people, this can turn into hundreds of thousands, millions of dollars that you've left on the table simply because we want to get to a quote unquote goal that we were taught when we were very young that we should all be working towards.
Yeah, it's definitely a goal of many people. But I'm going to argue that it's not a goal of the wealthy. It's not a goal of the people that are working towards, strengthening that financial floor, like you are listening right now. We want to thank you for listening. And, if you heard anything here and you want to kind of take a deeper dive, then we encourage you to get on a call with us. Let us know your situation because we can help plan those next moves for you. You might even have the wonder that says like, well, if I use my home equity line of credit and I could buy, I could add to the asset with a whole life insurance policy, but why wouldn't I just put that in the stock market? Like we can talk about what that would mean and why you might not want to do exactly that versus doing two things at one time. So hop on a call with us. You can head on over to CanadianWealthSecrets.com/discovery. And we're going to kind of talk through your situation and talk about what you could be doing to build your financial floor and make it concrete, make it stronger and raise it up.